Cash flow drives the value of a company, and cash flow is driven by return on capital and growth. Taking shortcuts to make things look better in the short term almost always comes back to bite you. Okay? One of the biggest factors that determines whether an acquisition is successful or not is the price that you pay. You got to know what things you should move fast on and what things you should move slow on. M&A is not a strategy.
I'm very excited to have Tim on this week's episode of the Silicon Valley Podcast. Now, before we start and dive into the challenging questions, which I'm sure are going to be a breeze, Tim, could you give our audience a little bit of background, a little bit of your stellar career and your accomplishments up into this point before really diving into the questions?
Well, thank you for having me, Sean. I think I've been very lucky to be able to pursue the passionate questions that I have. I joined McKinsey about 39 years ago when we were just starting up our corporate finance practice. We wrote a handbook for McKinsey consultants, and someone suggested turning it into a real book. And some publishers liked the idea, and now we just published our eighth edition. So we've been on the market for 35 years now. We've sold 1 million copies. And I think the book is successful because it is a nice blend of practical guidance on how to think about value creation, along with a strong theoretical grounding, and enough technical information on finance and economics and accounting that has made it successful. And that has allowed me as well to work with hundreds and hundreds of companies on very important strategic questions over my career. So I feel like I've been very lucky to be able to do all that and have had the opportunity to pursue things that are very interesting to me.
Now, I'm wondering, that first handbook, what was kind of the information that was in it? And were you concerned at that time of kind of giving away the secret sauce?
There was a discussion about that in the first handbook as to sort of whether or not we were giving away the secret sauce. But I think that the view that prevailed was, this is not something that's necessarily we want to be proprietary. We specifically would like everybody to think about value creation the same way, right? And so we think that our objective was more to be able to help as many companies as possible sort of think about value creation, what we believe is the right way, and use that so that they can maximize the value of their companies.
It's odd to think about, but I wonder how many additional billions, if not hundreds of billions, in wealth creation has occurred just by having that book printed when it had been printed. Has anyone ever done a study or thought about how much additional value to the whole economy that book has kind of been the result of?
Well, thank you so much. It's not something we've ever tried, but I do know that from time to time I will be visiting a new CEO and they will say, "Oh yeah, I remember I used that book 20 years ago when I was in business school." Today, as a matter of fact, I met with the CEO of a company who had a second edition of the book. The fact that people remember it and refer to it and has really been rewarding and a sign that they are, people tell me all the time it's changed the way they think about it. So about value creation and clarified it and those kind of things. So that's why I think it's been successful and it's pretty exciting, but we haven't attempted to measure it.
Has the information in that book, has it really changed quite a bit over the years, or is the fundamental core that was there in the first edition, very similar to what's in the 8th edition?
Yeah, the fundamental core is the same as what was in the first edition. What has changed is over the years, since the 35 years or so, we've had a number of new business models emerge. We've had the .com bubble and bust. We've had a number of we've had obviously technology change, new those kind of things. We've had a pandemic, so we've learned how to incorporate what's going on in the world and how to think particularly about, let's say, new business models, right? That maybe we didn't think about before. So the fundamentals haven't changed. It's still, cash flow drives the value of a company, and cash flow is driven by return on capital and growth. Those haven't changed at all. We just try to adapt to what's going on in the environment and help people apply that given whatever the environment is at the time.
When is it with the environment changing that there's a big enough event to fundamentally change how you look at valuation versus, oh, this is just kind of a hiccup happening in maybe the world or the economy? Like, when does one of those, like you mentioned a couple of huge events, when are those events, I guess, big enough to make that shift?
Well, I don't think there's a shift in the fundamentals that will ever. I mean, the ideas of how companies create value go back to the late 19th century in the writings of Alfred Marshall. The idea of earning a return on your capital, over your cost of capital. He didn't put it in those words, but that's essentially what he was talking about. That will never change, I don't think. There was a lot of, during the dot-com bubble, people would say to me, "Oh, Tim, you don't get it. You live in the world of Newtonian physics. We're now in the world of quantum physics, and the way valuations are going to work is entirely different now." And that turned out not to be true, right? Things came back down to earth, and I find that we look at hundreds and hundreds of companies a year, and our approach mimics the value of those companies very well, and therefore the drivers of value. When I look at, one of the things I have learned over the 35 years, right, is that there are bubbles that occur. The bubbles are usually concentrated in a small sector of the economy, and I think I think I understand now why the bubbles occur, right? So, and that's what makes it interesting, and you can look for signs of that. So, for example, right now, if you look at the Magnificent Seven or whatever you want to call them, right? One of the things you'll note is that the retail ownership of those stocks is about twice what it is the typical company in the S&P 500. So what tends to happen, it's not the stock prices are driven by they're not driven by sophisticated long-term intrinsic institutional investors, right? So what's happening is you get a bunch of retail investors who get excited. They're not actually crunching any numbers, right? They think, okay, this is a great company with a great product. I'm excited about it, so I buy the shares. Then you have trading-oriented investors who are saying, it may be overvalued, but it's going to keep going up for a while. So I'm going to buy in and write it up, and I'll get out fast enough. And then you also have the funds, the institutional investors who say, well, if I'm not in these stocks at the end of the quarter, when I report my portfolio, I'm going to look like I missed something, right? So you have all these forces pushing up the share prices of some companies from time to time, and nothing to counter that, right? Short selling is just way too expensive, way too risky, and there's not enough short selling to keep the prices in line. Eventually, they always come down, right? There have been bubbles. There's the dot-com bubble. There was a bubble in large company stocks in the early 2000s. There was a bubble in biotech stocks. There was a bubble in payments companies stocks a couple of years ago. They always come back to life, and I don't anticipate that changing.
I'm kind of wondering right there. I mean, it almost sounds like the best investment is to just do marketing to read. Don't worry about how the company's fundamentals. Just work on your marketing and your push of the company out in the general public.
Well, there's two. One is if you could do that. I mean, it's not likely. You have to have something really sexy new that people get excited about. That you don't have to do your own marketing, right? But it is going to come down eventually to reality, to something that's reasonable. And I remember talking to the CFO of one of the largest tech companies shortly after the dot-com bubble. And he said having that inflated share price was one of the worst things that could happen to the company, because when it came back down to earth, employee stock options were underwater. Everybody was demoralized. The board wanted to know what was going on. So it actually, yes, maybe you could talk up your share price if you were really good at it, but it wouldn't be a smart thing to do because you can't maintain it at an artificial level for more than a couple of years, and if you do, when it comes down, everyone's going to be disappointed. So it's no way really to run a company.
I'm kind of curious to go way back to the very beginning of your career. What was it like then to do, models without Excel, build in valuations? Any stories from that era, that time?
You do have to go back prior to my joining McKinsey. I worked for a small firm called Stern Stewart and Company, and that was before the spreadsheets, or just as they were starting. And we developed our own software, and so that's how we did it back then. And then fortunately, when I joined McKinsey in 1987. Lotus 1-2-3 was pretty well established. Microsoft Excel had come out recently. There was no mouse though at the time, for example. So, it wasn't as easy as it is now, but the basic functionality was there. So it's gotten easier over time to do things as these spreadsheet programs have improved, have gotten better. I don't know what I would do without a mouse now. But we worked without mouses. Everything was, clicking on arrows to move things around. Right. So it took a lot longer, but the spreadsheets, in a way don't look that different. There's not as many formatting options and that kind of stuff, but the essence of them is pretty much the same.
And what's kept you kind of focused or excited about valuations this whole time? Why not pivot your career into something else?
Yeah, I had a colleague ask me that question one time, and I think it's because it's not a static field, right? I'm always learning something. What we find is that if two clients ask the same question, it means that there's a lot of people out there with a question, right? So we started out with just financial modeling, linking it to strategy. Then we started answering questions like, well, what about share repurchases and dividends? What about capital structure? What about investor communications? That's something we never thought about. But we got into investor communications because we were talking to clients and they were doing things because they thought that that's what investors wanted, even though they didn't think it was the best thing for the company in the long term, right? This doesn't make any sense. We need to understand investors better. So then we started doing research on investors, discovered, yes, there are a lot of long-term investors, very sophisticated, who don't want companies to take those short-term actions. And then I observed that, and some of my colleagues, of course, that companies, we were coming up with great strategies, but companies weren't doing a very good job implementing those strategies. So then I started delving into, okay, what can we do to help companies to execute against their strategies better? And that brought us into the world of psychology and the social side of what goes on inside a company. And now I've been spending a lot of time on, okay, how do we help companies allocate resources? I'm working with a psychologist named Dan Lavallo, who is a professor at the University of Sydney, who trained under Daniel Kahneman, who was the Nobel Prize winner, the founder of all this cognitive behavioral bias decision making. And I was fortunate enough, we wrote some papers together, and fortunate enough to publish a paper with Kahneman, a Nobel Prize winner, in the Harvard Business Review. And so, it's always been sort of, we had a foundation, and all these things have been building on top of that foundation, and they all reinforce each other. So if I was doing exactly the same thing as 35 years ago, I probably wouldn't be very excited. But it's because we've been able to continue building on that and expanding it and broadening it out to sort of related areas to help companies to do a better job of value creation. And then also, to be quite honest, the ability to influence the broader, world about value creation, both through my books and through consulting. The impact that we have and the way we change companies' thinking is pretty exciting. Even if sometimes, I end up giving a similar presentation over and over again to different groups of executives. I get a lot of energy as long as the executives are engaged, and they usually are. So, it's like sort of feel like a professor who teaches the same class but develops a reputation of being really good at it, and the students really, want to come and listen, and they provide the energy.
I'm kind of curious. I mean, you get to talk with some of the most elite businessmen and women all day long. These executives, what are some of the most common questions they ask, or maybe what's an area that's a misunderstood concept in corporate valuations today?
Well, there's a lot of misunderstandings still. So we've broken down a lot. So, for example, when I started, people didn't focus too much on return on capital. Lots of people now focus on return on capital. So that's been good. Their companies CEOs, CFOs still come constantly and say, our shares are undervalued. That's the common complaint, right? And I said, well, can you show us the analysis? So they typically haven't done it, or it's been very superficial. And then when we do dig a little deeper, we say, okay, well, here's why your shares are valued the way they are in the market. And here's what you need to do if you want to get that up, right? You can't talk it up, right? You got to do, here are some of the strategic things that need to happen, right? There's a perception that investors, that the market is sort of a monolith, if you will, and that the loudest investors must be the most important investors, which is not true at all. What we have found, for example, is that the investors and the sell side analysts who ask all the questions on the quarterly calls, typically are very short-term oriented. The long-term investors don't want people to know, what they're thinking, so they ask their questions in private. But they have a very different perspective. Their dialogue is very different. And so, companies or executives still think sometimes that it's a different set of investors who are ultimately driving the share price than are, right? Yes, these short-term investors drive the short-term share price. But if you think about the share price over, a year or two, it's really driven by much more sophisticated investors. Firms like Wellington and Dodge & Cox and Capital Group and Vizina. Those are the kinds of investors who really make a difference that you should be focusing your communications on and that you should be listening to. And if you listen to those investors, you'll be much more long-term oriented.
That's interesting. Now, could we dive a little bit deeper into that? The mistake of executives trying to translate strategy or short-term, but with the long-term value, long-term vision.
Mm-hmm. Well, I think the big issue, there's a big disconnect between, companies typically have, they do a strategy sometime in the middle of the year, let's say. But when it comes around to budget time, a lot of the ideas in the strategy don't make it into the budget. Right? And in fact, we did a survey and we found that less than about 30% of executives felt that they did that there was a pretty strong similarity between what was in the strategy and what was in the budget for next year. So what we've set out to do is figure out, well, why is that the case and how do we fix that, right? So some of the things are things like, okay, first of all, if you have a strategy, every strategy should have a set of initiatives that has somebody responsible for them. Shouldn't just be something on a piece of paper, right? That's number one. Number two is you have to have the right governance. The CEO and the CFO have to make sure that there is money in the budget for those initiatives, and they have to make the tough decisions to take that money from somewhere else, right? And so they have to be involved enough in the details to be able to sort of see that that is actually happening. I think is a big part of it. So when it comes to governance and decision making, well, sometimes we say you want to have an aggressive debate. Debate is a good thing, right? But you can't make a decision with 15 people in the room. You can't make tough decisions. CEO can't say, we're going to take resources away from you and give them, to somebody else in that room very easily. So what we often advocate, for example, is separating debate from decision making. You want many people involved in the debate about how to allocate resources, but when it comes to decision making, a small group, CEO, CFO, a couple others should need to go off and make the decisions and then explain why they made the decision. Right? You also need rules in place to ensure that spending makes it into the budget, and that some executive farther down in the organization can't say, oh, in order to meet my number this year, I'm going to cut back on product development, right? And so the only way, you need some mechanisms to make sure that those kind of decisions are only made by this, if you decide to cut back on product development, that's the kind of decision that should only be made by the CEO, for example. So there's a whole range of things: better analytics, streamlined processes, techniques for debiasing decision making. We're talking about cognitive biases. There's inertia that you need to overcome. There's some techniques that are out there for overcoming inertia. There are techniques for overcoming loss aversion. That was the article that we wrote with Daniel Kahneman in the HBR. It was titled "Your Company is Too Risk Averse," right? Because companies think about projects individually and the risk of them as opposed to a collection of projects. You also have to do things to encourage executives to take on risky projects. You have to do things to overcome groupthink or situations where everybody just tries to figure out what the boss wants, right? So you have to train the CEO on how to run a meeting, for example, right? You don't come in with your opinion. You got to listen to other people's opinions, right? You got to learn how to stimulate debate. There's all kinds of things that need to be done to do a better, help companies translate strategies into actual actions. Now, you're not going to do all the things I just talked about, but usually a handful of things will make a big difference.
Now, you mentioned one thing there around companies when they become too risk adverse. How does that affect the ability to create sustainable value?
It's a tremendous effect because, and if you look at an industry like consumer packaged goods, right? A lot of the innovation has not come from the big companies, right? They've been slow to catch on. Like if you look at something like Greek yogurt in the US and how popular that has become, right? Those were not, any of the big yogurt companies, right? If you look at iced teas, that was not the big companies, right? If you look at alcoholic seltzers, which are very popular right now, that was not the brewers who came up with those ideas, right? So these companies are, the bigger companies are losing out because they are not innovating oftentimes. And they're competing against people who've got ideas and who can get the backing now to get things going. So they end up coming in kind of late, the bigger companies, and I see it across many industries, not just consumer industries. Something like 3D printing, right? It's all driven by small companies. Okay, so why couldn't big companies do it? There's no reason, but it is, it's because of this, partly because of risk aversion, loss aversion, partly because of they just don't have the right kind of people or the right incentives, et cetera. So, big companies are losing out and their shareholders are losing out. Fortunately, from an economy-wide perspective, it really doesn't matter who does the innovation, right? So we still benefit from, as consumers, in terms of the GDP growth, et cetera. We still benefit from the innovation. It's just often coming from the big companies.
Well, with that, then, in your experience, what are the biggest behavior or cultural barriers to long-term value creation inside companies?
The biggest cultural barriers inside companies are, I would say, there is a fair amount of groupthink that often occurs inside companies, right? And where you've been inside a company, everybody thinks the same way, and people are afraid to raise questions or to have a contrarian point of view, right? You see that a lot in larger companies, right? And I often, and one of the reasons often my colleagues bring me in to help them with their clients is that I'm coming into a new company with, a blank sheet of paper, so I can ask all kinds of questions. I don't have any preconceived notions, right? I can ask the difficult questions, right? And so if you don't have that culture where people are asking those difficult questions about what's going to happen to the industry, what should we do, how quickly we should move, et cetera, you're gonna end up like a Kodak or a Polaroid, right? Who the writing was there, but they didn't act, kind of thing. So I think that groupthink coupled with inertia, right? Inertia is a big thing, right? It's very difficult for companies, larger companies in particular, to aggressively move resources around, right? There's a lot of, oftentimes the biggest units are the mature units that don't have a lot of opportunities, but they often are headed by the guys who've been around and have a lot of clout in the company, right? So they get more resources than they probably deserve. So, there's that sort of bias, if you will, that, okay, the people who are the most senior, the most outspoken, the most articulate, get their projects done, even though they may not be the most important to the firm. So those are, that gives you a sense of the kind of social challenges inside of companies that prevent them from thinking more long term, or I should say, acting more long term, and overcoming all these barriers that get in their way.
And earlier in the interview, we talked about kind of the valuation fundamentals have been there from the beginning, haven't really changed. But I am curious, what about when there's new factors such as ESG or AI? How does that play in when performing valuations today, and how do these get priced in to the valuation of a market? And I'm guessing there's a lot of misunderstandings. I have no idea when they say ESG or half these terms how they actually really mean. So could you unpackage that a little bit for our listeners?
Sure. Well, let's take AI for a second. We need to divide AI into two things. There are companies that use AI in their business, right? And then there are companies that are selling AI products. Let's take companies that use AI, because that's the vast bulk of companies, right? AI, what does AI do for you, right? It can help you lower your cost by managing your inventories better or improving your manufacturing process. It can improve customer service, which will hopefully allow you to gain market share, perhaps. It can help you optimize your product assortment. But it doesn't fundamentally change your business, right? You're still pretty much selling the same product or service that you were selling before. You're just doing it better, right? And so it's like any other kind of productivity improvement or sales improvement or product improvement or whatever, right? It's just being done by AI. But the manifestation of cash flows comes through selling more or at a lower cost, right? And generating more cash flow. So there's no trick to the valuation there. You figure out how's it going to affect a company's ability to, keep, attract, get more customers, lower their costs, et cetera. The thing to keep in mind, though, is that while one company is doing all these things, its competitors are probably also doing exactly the same things, right? So a lot of these benefits, let's assume that you're a retailer and you figure out a way to using AI to make the customer experience better. Your competitor's doing the same thing, right? So you have to do it, otherwise you'll destroy value. But it's not necessarily going to increase value. So the second thing you need to think about is, what is the second order effect? If I do these things and I lower my costs, But if my competitors do it too, will we end up passing on those savings to our customers? So the economics may actually be a little bit smaller than you might expect. But you can go back and you can look at the automobile industry, like innovation in the automobile industry. The cars today are so much have more features. They handle better. They're faster. They're safer, and yet they don't really cost any more than decades ago, right? And the car companies don't make any more money than they used to, right? In fact, they may make less because of competition. So it's important to think about that, competitive dynamic, if you will, and how that affects. You have to apply these tools, but you may not be able to keep the benefits. When it comes to companies that sell AI products, right? Once again, it's a matter of thinking about what's their business model, what are the cash flows going to be like, right? So a lot of the benefit so far has gone to companies that provide the web services, right? And the companies that supply them. If I'm building a lot of data centers, I need air conditioning, right? I need electricity, right? So that's one part of it. And then, but we don't yet know how the software side of it is really going to play out in terms of business models. But eventually, it will be like any other software business, right? Where you either sell a software or you provide software as a service, and you get some kind of fee from the customer for using that software, right? That's how it's going to generate cash flows. So, AI is not that different in that sense, right? It's like any other software tool that you have to sell it to customers who have to pay you real cash in order for you to make money.
Okay. What about ESG? Because that's not necessarily implemented for efficiency or that, but that is kind of an outside score almost.
Mm-hmm.
How does that impact?
Well, first of all, and what we found is that it still boils down to cash flows, right? Investors don't care about, there are these companies out there that will provide you a score, right? Yeah, that's useful for retail investors maybe who care about that. But sophisticated investors, at least the ones I talk to, are trying to understand the cash flow effects. So, what are what are the things that are going to damage the value of a company? Regulation and those kinds of things. Try to model that. What are the things that the company can do defensively to counter the effect of regulation? Right. What are the things the company can do to take advantage of ESG? Can I develop products that will appeal to certain customers, et cetera, that will therefore generate cash flows? So the sophisticated investors are still thinking about cash flows. They're not. There was a bit of hype a couple of years ago about ESG funds and those kinds of things. That has all gone away because people have realized that you don't get investors aren't going to pay extra for something just because you're a good citizen, right? If you're a bad citizen, they probably will penalize you because something bad is going to happen eventually. But being a good citizen, you get value based on your cash flows.
I mean, kind of. I don't want to say looping that in one circle, but I am kind of curious if there's any corporate finance fads or frameworks that you feel have done more harm than good.
Frameworks that have done more harm than good. Well, I'll give you an example. Back in the .com era, there was a book that was written by Halvarian, who I think he was a professor at Berkeley at the time, right? And the co-author's name I can't remember, called Information Rules. And in that book, he talked about the idea of increasing returns to scale, right? That certain businesses, as they get bigger, like a search business, for example, right? The cost of adding a customer is very low, right? So you get more customers, your economics improve. as opposed to in many businesses, traditionally, we think about declining economies to scale, right? So you have increasing economies to scale. So that was a great idea, right? But most people didn't read the book. They just heard about this idea, right? And if you actually read his book, you would see that, a couple pages after he explains the idea, he talks about the fact that it's very rare for these conditions to occur, and therefore very few companies will benefit from it. Okay. But what happened is people just took people had the mantra in the early 2000s was get big fast. Okay. And you had companies like electric power producing companies who were, the theory was get big, we need to get big fast. We need to buy plants. We need to buy power plants. We'll figure out what to do with it later on. You had these companies and a lot of the independent power producers that were spun out of spent a ton of money buying random power plants all around the world, right? Borrowing up to the hilt to do it. And then they sort of figured that they would figure out how this is going to, create value at some point, right? They all went bankrupt. Okay. So the idea of, of size providing any kind of benefit, I think is still, was a big error in both in the dot-com bubble and the subsequent years after that, where there was still an emphasis on size, right? As providing some benefit. And to some extent, there still is, people do still think that size provides some benefit, which is often not the case. Smaller companies are often more nimble. They have less overhead, less coordination costs, et cetera. So I think this idea of size is one of the ideas that sort of, there's extreme versions of it, but there's also milder versions of it that are damaging.
Speaking of size and companies, I mean, you've advised countless companies on M&A deals. What's one thing that buyers consistently overlook when pursuing acquisitions?
When companies do acquisitions, there's a couple of things that can go wrong. Oftentimes, it is in the execution. By the way, after the deal is done, where things go wrong, because they put so much energy into doing the deal. I know one company that did a postmortem on their acquisitions and found that was the biggest problem. Right? Was they didn't, they said, we're going to buy this company and then we're going to make these investments to grow the company faster. But when once the company was inside, then there was no money in the budget to grow to make those investments, right? So execution is a big issue. And then the other issue is just the discipline around the price that you have to pay. One of the biggest factors that determines whether an acquisition is successful or not is the price that you pay, right? And you have to be disciplined about that. You have to be willing to walk away. So I think that's the other thing that comes into play. I think those are probably some of the biggest issues that we find with acquisitions.
So that's with the acquisition. What advice would you give to a CEO that's maybe for the first time thinking of acquiring a company? Mm-hmm. to add it? Any suggestions or insights to say, before you even go down this road, here's some things to think about?
Yeah. Yeah, that's a really good way of putting it, because M&A is not a strategy, right? M&A is a way to execute a strategy. So the first thing I would tell them is, what are you trying to accomplish, right? And is M&A a good way to accomplish that, right? And so that's really one of the things that people fall into the trap of is, we want to get bigger, so we're going to do M&A. So that's one thing. The second thing is not investing enough in finding the hard to find targets, right? Waiting for deals to come to you. If you're waiting for deals to come to you, you're probably going to end up overpaying because it's going to be an auction, right? I remember having a lunch with an executive at one of the major consumer companies he said, I'm going to be having lunch tomorrow with a company that we may buy in 5 years. So the best companies, develop relationships with companies that they want to buy eventually, right? Because they have products, and then they're likely to avoid an auction or a bidding war. So making sure you have a clear business strategy that where M&A can help you achieve your objectives faster or with more value creation. And then secondly, investing enough in finding the companies that might fit your strategy, and developing relationships with those companies and having some patience.
I'm kind of wondering right there, because you'd mentioned, the CEO having a lunch with someone they might look to acquire in 5 years. So many acquisitions right now are done by, private equity groups or these groups that have a limited time horizon. Where do you see kind of the pushing the valuation to the edge to make sure they get a certain number of deals done in a time allotment allowed?
Mm-hmm. Yes. Well, I think the private equity firms, they vary a lot in terms of their quality, right? But what we find is that the best private equity firms are successful because they're able to improve the performance of that business over, let's say, a 5-year period, right? I remember talking to a former colleague who had been the CEO of a publicly traded company and been the CEO of a private equity owned company. And he said the difference was, he said he felt that as the CEO of a public company, he had a series of 5 1-year plans, whereas private equity, it was 1 5-year plan, right? So private equity does have an advantage in that they can do things in the first couple of years to shake up that business, right? To prepare it to look good in 5 years. Whereas larger companies, because they're so focused on steady earnings growth, they're unwilling to do the shakeups that need to get done, right? That's why they end up divesting to the private equity firm, because they're not in a position to do what a private equity firm is to restructure that business that they're selling, let's say. I think that even, private equity firms, the better ones, do have a longer term view when it comes to the operating performance of the company.
That's interesting. How often is your advice to, when you're brought in to consult, is to actually just sit back and increase the time horizon, or not act so immediate, but act or think about it over stages over the coming years, or space things out? How often does that come up in conversation?
Not as often as I would like. Okay. Because there is a tendency among CEOs to be, want to be perceived as always taking action, when sometimes it's better to wait, right? So it is a difficult conversation for companies to just wait. The boards aren't always comfortable with that, or they don't understand it, or whatever. So, I'm a little disappointed that it doesn't come up more often, and that companies aren't a little more patient. Sometimes moving fast, you can move fast on organic growth, but sometimes on other things you need to move slow and see how the market develops. It's figuring out. I think one of the things you just triggered there is the idea that you got to know what things you should move fast on and what things you should move slow on. And I don't think executives think about that explicitly enough.
Other than that, what would be a lesson from your book Valuations that you wished every first time CEO would internalize?
I think the lesson to internalize is that is to run the business for the longer term. Especially if you're a new CEO, you have the opportunity to do things that you couldn't do if you'd already been in office for 5 years, right? So it's a time to invest for the future of that company, to shut down or restructure parts of the company that aren't doing well, accelerate divestitures. It's a time to invest in growth in new areas, and also to do things like get rid of extra layers and those kinds of things. Right? These things will often disrupt your short-term earnings, but that's okay. The worst thing is when CEOs come in and they say, well, I'm going to, in my first year, I'm going to increase the profits by 10%. Oftentimes, the only way to do that is by cutting costs on things like product development and marketing and sales, which is going to hurt the company longer term. Right. So that would be my key advice. And I often will, when I'm talking to a new CEO, I'll say to them, you have a one-time opportunity here to really, make this company that much better. Right. But you have to take advantage of that. And it's going to be a little messy in the first couple of years.
That's interesting. I mean, I just wonder how many CEOs out there are thinking, I have the time to actually take 2 steps back before taking 5 steps forward, or even if I take 1 step back, that could be my career right then. So
a lot of them think that, but that usually is not the case. And they ought to be, when they get the job, they ought to have a clear mandate from the board to be able to do those kinds of things.
What are some of the other items or new topics or themes that readers should expect in the 8th edition of Valuations?
In the 8th edition, we talk about some of the things you asked about. There's a chapter on technology, right? Whether it's digital or AI or different kinds of things. How do you factor that into valuations? We have a chapter on, ESG. We call it sustainability. We have a chapter on venture capital. We have a chapter on high growth companies. So those are some of the newer things. And then we also reflect on, what's been going on in the world. Like we had a period of ultra low interest rates. How did that affect, valuations and the cost of capital? Those kinds of things. So there's different, things like that scattered throughout the book.
So before wrapping things up, and just another question or two. One, I mean, I'm not sure if you're open or not, but I'm really curious what some of the craziest businesses or that without saying any names that you've been asked to put a value on. But I'm also curious if there's any key things out there. You'd mentioned cost of capital being very low, that always perks your ear, that gets your attention if you ever hear anything like that. Either it's a world event someplace in the world or an election coming, or is there anything that through all your experience, like when this happens, I take notice?
Well, I think inflation and interest rates are big factors that we always have to keep an eye out for as to what the impact is on company value creation. So I think those are things that I pay attention to. Some of the things that we're experiencing right now in the political world are, with tariffs, are kind of scary, but we don't know how that's really going to play out yet, right? So anything that disrupts the free flow of goods and services is going to be problematic, right? Because the world is so interconnected. Right? But otherwise, I for the most part, I have a very optimistic view, right? My view is almost that the economy is stronger in the long term than any government, right? At least the U.S. economy and parts of Europe, and we will, unless there's some major disruption to the ability to do business and competition and that kind of stuff, we're going to continue to have innovation and growth as a result of that. Now, there are some things that we do have to worry about, like demographics as well. Got to mention that one. The U.S. is lucky in the sense that, if we manage it right, we can replace, declining birth rates with immigration. Other places are less willing to do that, or aren't as attractive to people who, we attract a lot of entrepreneurs here, right? So I tend to be long-term optimistic, even if I'm short-term concerned about things. I'd say those are the things like I keep an eye on. I mean, I always want to know what's going on, but usually the impact is, we can figure out what the impact's going to be without too much difficulty.
All right. Is there anything that we didn't cover that you'd like our listeners to be aware of? And then if not, if they want to read your book, what's the best way to get a hold of it? What's the best way to find out more information what you're working
on? To get a hold of the book, the easiest way is you can either go to the McKinsey website or you can go to Amazon. Amazon is obviously somewhere easier. Just make sure you're getting the 8th edition because for some reason, Amazon sometimes will pull up one of the older editions when you do a search. So search for McKinsey Valuation, for example, and that'll usually get you to the 8th edition. The other thing is we have a publication called McKinsey on Finance, which comes out quarterly. The online version of it is free. You can sign up. Just, go to, search for McKinsey on Finance and you'll make your way to that page. And you can sign up to get the edition every quarter, and you'll get a sense of what we're working on and what clients are asking us that we're trying to come up with answers. And it also has a ton of, we've got 88 issues out there now. We've been out there for 25 years almost. And you can look through the back issues for topics that are, especially in the last couple of years, that might be interesting to you.
Any key takeaways for our listeners?
Key takeaway is if you're an executive or an investor, focus on the longer term, right? Taking shortcuts to make things look better in the short term almost always comes back to bite you. So, take a longer view is the one key piece of advice that I'm always trying to give executives and investors.
Fantastic. Tim, I can't thank you enough to be on this week's episode of the Silicon Valley Podcast. We're going to have all that information in the show notes. For our audience out there, if you'd like to find out about our past guests, our archives, please go to thesiliconvalleypodcast.com, where you'll find out not only about our past, but also what we're working on, future guests, and things to come. And when I'm not the host of the Silicon Valley Podcast, I'm an investment banker focused on mergers, acquisitions, and growth capital. Connect with me on LinkedIn. And with that, Tim, I got to thank you one more time for being a guest on this week's episode of the Silicon Valley Podcast. Thank you.
Thank you, Sean. I really enjoyed it. Thank you.